Good afternoon and welcome to the FRP Advisory Group PLC investor presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged, can be submitted anytime via the Q&A tab situated on the right-hand corner of your screen. Just simply click Q&A, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Jeff Rowley, CEO.
Thank you, and good morning, everyone, and thank you for taking time to join us today. You have myself, Jeff Rowley, CEO, Jeremy French, our COO, and Gavin Jones, our CFO. About FRP, just to reconfirm our value proposition, we are a specialist advisory firm delivering services through 5 core pillars with a strong track record of profitable growth. Our strategy centres on organic growth bolstered by strategic acquisitions, all underpinned by a collaborative, entrepreneurial and meritocratic culture. Amidst increasing market activity and demand for advisory services, our client base is diversified both across geography and sectors and continues to expand. The business has an experienced management team, a growing reputation, increasing profitability and strong cash generation. Our 5 specialist service pillars are restructuring advisory, in which we have 63 partners, and that covers the complete spectrum from solvent reorganisations through to administrations and complex investigative-led liquidations. Our corporate finance offering, which now has 18 partners, and that fundamentally is driven around M&A advisory, strategic valuations and raising capital for clients. Our debt advisory team, which both supports M&A activity as well as corporates who are addressing their funding needs. Financial advisory, which has 7 partners, and that covers a range from C-suite, board advice, transaction services, both vendor due diligence and financial due diligence, advising lenders, financial modelling, valuations and pensions. And lastly but not least, our forensic services, which now has 5 partners, and that covers across investigations, disputes, compliance and risk advisory and forensic technology. As of today, we now have 102 partners, a total team of 750, and we're operating across 30 office locations, 28 of which are in the UK and 2 are outside the UK. We continue our membership of 8 International, which primarily is around restructuring and forensics on an international capability. We're members of the Institute for Turnaround. As regards our corporate finance activities, we're members of the BVCA, and we are a member of the Alliance of International Corporate Advisors. As hopefully everyone's aware, fundamentally we are an organisation that seeks to deliver specialist services to support throughout a corporate's life cycle. Starting with corporate finance and debt advisory, during the year the average deal value was approximately 20 million, which maintains FRP Corporate's finance position in the heart of the lower mid-market. Just under half, 43% of the deals in FY 2024 involved private equity. And as you will have recently seen, post-year end, we acquired Lexington, giving ourselves a corporate finance footprint in Wales. UK economic conditions have stabilised and market sentiment improved. Our corporate finance, including debt advisory team, are cautiously optimistic with a good pipeline and momentum as we move in and through FY 2025. Heightened demand for pre-deal due diligence and debt advice is extending completion timelines as investors are making sure they're transacting on appropriate deals. Within financial advisory, this was the first full year of trading for the combined financial advisory pillar and has been a positive one. There's been high demand for independent business reviews, pre-led reviews, transaction services such as FDD and VDD and valuations, and that reflects the current risk environment. Within forensic services, we had a busy year across a multitude of investigations and litigation/arbitration disputes. There's been an increase in contentious insolvency projects requiring our forensic accounting and forensic technology input. And then finally, but not least, within restructuring advisory, we've remained active across the country, across different sectors, and notable high-profile assignments have included The Body Shop, Wiggle, Inland Homes, Just Cashflow and Reader's Digest, and many mid-sized high-quality projects throughout the UK. Despite positive signs in the economy, we do continue to believe that many businesses will continue to face challenges in the current year and beyond as they navigate their way through an increased cost base and higher cost of borrowings, with lenders' appetite for risk changing.
In terms of the financial highlights, the key thing, our reported results are in line with the trading update we gave mid-May, and we are pleased with this strong set of results. Revenue growth was 23% year on year, and the vast majority of that, 19%, was organic growth. Adjusted EBITDA, which is the profit metric we invite people to judge us upon, grew 37% year on year to 37 million. I've always said FRP strives for a high 20s margin, and we were pleased to report a profit margin of 29% for FY24. In terms of cash at year end was 29.7 million. Above and beyond that, we have an undrawn 10 million revolving credit facility, and we had a acquisition facility which we drew down for the Hilton Baird acquisition. This highlights we have a very, very strong balance sheet. Adjusted total EPS grew 27% year on year, and in line with our dividend policy, we pay three smaller interim dividends and a larger final dividend. Dividends grew 9% year on year, and with this final dividend that's recommended to shareholders, dividends will be 5p for the full year. This graph shows FRP has a strong track record of growth. Over FRP's history, revenue growth or compound annual growth has been 15%. However, when you look at growth since IPO, when you compare 2020 to 2024, when you look at revenue, the number of partners, the team size, profitability, the business has approximately doubled over those 4 years. And we would argue that this chart shows that FRP has a track record of growth regardless of the economic conditions. In terms of operational highlights, FRP has an administration market share of 16%, which is the leading market share by volume in the UK. We are particularly strong in the mid-market. However, FRP continues to serve the full spectrum of cases, from personal SMEs right up to high-profile cases like Body Shop. To underpin our position in terms of restructuring, we are very active in thought leadership, and we run various campaigns. This year, we did a campaign in fintech, manufacturing, retail, construction. During the year, the team grew 19%, a mixture of demand-led lateral hires and acquisitions. We did 2 acquisitions in the year and 2 post-year end, and Jeremy will give you further details on that later on. We're also pleased with our work in progress. Our WIP days were approximately 5 months. The work in progress or unbilled revenue you see on our balance sheet is our net recoverable work in progress. I always mention that we've got a monthly diligent process to the extent that we ever have any concerns about recoverability, we provide immediately. Anything that is contingent, we carry at nil. Back to Jeff in terms of a few words on our strategy.
Yeah, so fundamentally, we're looking to support clients around preserving and creating value. We'll just touch upon a couple of projects from here. But in the year, we undertook a value preservation exercise for one of the UK's largest direct mailing businesses. We've been advising a listed retail business. We facilitated the sale of one of the UK's largest seafood producers. We supported a premium health club through a complex debt restructure to ensure its survival. We sourced additional funding for a major UK distribution, and we supported the sale of the Trafford Centre to the mezzanine lender following the collapse of Into a few years ago. One of the things we've always commented upon, which is we see as a strength of FRP and sort of intangible value within how we operate, is our cross-pillar activity. We continue to encourage for people and our teams to think across what we do rather than having a silo mentality of just their individual specialism. And here's a range of projects that have all involved more than one service line. I think it's fair to say that in the main, it's a pretty straightforward position that if we've got more than one service line involved, our financial opportunity in a project tends to increase. So it's not only good in the context of making sure that we're delivering for our clients, but that is actually good for FRP in the context of our ability to generate revenue. I'm not going to go through all of these, but one that does stand out was AMT Power, which was actually, I think, from a renowned listed business that had 8 of our offices across multiple service lines supporting them as they went through consideration of their options and ultimately a formal restructuring. But that whole cross-pillar piece remains key to making sure that we are properly serving our client needs, but also maximising our opportunity as a business ourselves.
A quick walk through market and team growth, and starting with the market. These two graphs. This is restructuring focused market. Graph on the left is all insolvency appointments. I think probably just highlight the fact that we're at 5.5% of all insolvency appointments, which is slightly ahead of the position in 2021. But obviously, the number of appointments out there over the last 12 months is considerably higher than during that COVID period. Place that we hopefully excel at in terms of the administration market on the right, up to 16%. You can see that sort of 1,600, 1,700 appointments across the nation is not yet back to pre-pandemic levels. And actually, if you go back beyond the start of that chart, those were some of the all-time lows in terms of where administrations have been. So we're hoping that with interest rates where they are, a more normalised market, that there would be upward trend within that market. On acquisitions, 4 mentioned, 2 post-year end. Wilson Field. And we went into Wilson Field because we had to decide whether we were going to develop or buy into direct inquiries from a digital platform and website. And Wilson Field, we are retaining the name Wilson Field within that marketplace. And they are an excellent performer, and indeed some of their systems are being more widely embraced. And I think we'll see as we talk about utilisation in a minute how we are looking to improve there. They've South Yorkshire based physically. We've gone to market in the South Yorkshire Sheffield area as FRP. Wilson Field is the web presence, and they have already seen strong growth through their on the ground presence. GWC in the Isle of Man, one partner. A quality business, but this is also gives us much stronger links into some of the work we do in the Channel Islands, Cayman and the BVI, and the ability to service clients with international and offshore exposures considerably enhances our capabilities. Hilton Baird, just post year end. This definitely deepens our ties with asset-based lender client relationships. This is a supplier of choice to the ABLs. You could probably take the view it's a supplier of first choice to a lot of ABLs. Their clients include independent lenders, banks, SME and corporate businesses, as well as other insolvency practitioners across the UK. We haven't seen any fallout from other insolvency practitioners continue to need their service, but again, it's important because for most things we do, we are FRP, but we will certainly be maintaining the Hilton Baird brand because it is a brand of excellence in that environment. And very recently, as already mentioned, Lexington, one partner into Cardiff with corporate finance. We will certainly be looking to add additional service lines within Wales to broaden local services offered to clients in that arena. I think the team growth chart almost speaks for itself, but 80% increase in partners over those 4 years, 87% increase in fee earners. And we're at a point where actually our utilisation at 68%, that's an all-time high for FRP. just commenting on the bar chart on the right, it looked like a cliff edge fall off in utilisations in 2022, but utilisation is a lot about the mix and type of work, and there's not an awful drop off in percentage wise across those years, but certainly up at a new level and hoping to push on from that new level. In terms of colleague update, we are a people business, and people make such a business succeed or indeed splinter and fail, and you have to focus on your people. Majority, if not all of the time. In terms of internal progression and promotions, we promoted 15 colleagues to partner during the year, 13 to director, and announced a further 72 promotions across a wide range of senior and specialist roles. Immediately following year end, we promoted another 7 directors to partners, and that really does show the strength of our internal leadership academy. New talent and evolution, 2 new board members, two retirements, and we welcome a new chair in Penny and a new chair of REM with Louise. We've got a new people director, Claire Dale, who has already fitted in supremely well. We push on there. We're launching a new podcast series, Mindset. The Save As You Earn was launched in June 2024, and a very, very good take up, apart from the fact I didn't take up because I thought the 3 of us were excluded and we weren't. So
Two out of 3.
yeah, ain't there. And secondary placing for IPO partners, 25% sell down in June 24, which now gives us a very comfortable lock-in on all relevant partners to July 26, and those partners collectively still own 30% of the business. Recent colleague engagement survey results, 84% of employees say they were proud to recommend FRP. I think that's an excellent result. At the other end of the spectrum, 13% of respondents said they felt they could not openly discuss mental or physical health and well-being with their manager or any other senior representative, and that is obviously an aspect we really do need to and are focusing on. Some of the actions in that regard: to implement a business-wide personal development strategy, continue rollout of wellbeing activities in partnership with the mental health charity, the Charlie Waller Trust, extend the London Balanced Mind Group nationally, and undertake a review of our approach to equality, diversity, inclusion, and develop a strategy therefrom.
In terms of our P&L, a couple of things to call out. I've already touched on revenue growth year on year. In terms of personnel costs, overall, it's 106 new colleagues. That's a mixture between acquisitions and lateral hires. I think it's worth calling out, we gave blended pay rises, including promotions, on the 1st of May 23 of around about 5.5%. The rollover point here is where people had joined us and had an element of the year in the previous year and a full 12 months in the current year. Equally, and I talk about it on the next slide, in terms of share-based payment charges. So in our reported P&L, we do have an offset here where we've got lower share-based payment charges in our reported P&L. They've halved from over 8 million to just under 4 million. We exclude those in the profit metric we invite you to judge us upon. In terms of operating expenses, we had general increases across a broad range of categories, slightly higher legal costs in 2024, but everything else you would sort of expect of a business like ours. Continued investment in business development, etc., etc. On the tax side, the charge is higher year on year. One, we were more profitable, but secondly, corporation tax rates changed in April 23 from 19% to 25%. So in the prior year, that impacted 1 month, and in this year, it impacted the full 12 months. In terms of the profit metric we invite you to judge us upon, and I believe this is officially called an APM, an alternative performance measure, we go by underlying adjusted EBITDA. The 2 key items that we adjust for are share-based payment expenses, which arise due to 2 things. 1, consideration which is deemed remuneration, and employee incentive plan option awards, which were funded by the partners on IPO, so there's no future dilution. Both of these items are non-cash and non-operating. In terms of the balance sheet, again, in terms of work in progress, this is our net work in progress. And we won't cover this in this presentation, but there are a few slides in the appendices of this deck that talk about WIP in more detail. There's also some slides on our competition and our referral network, and all of this whole deck will be available on our website. In terms of our balance sheet, in terms of goodwill and intangibles, there's a slight increase year on year due to the acquisitions. Earlier on, I mentioned strong net cash position. We have a really good track record of turning our net work in progress into cash. The WIP primarily relates to time and cost assignments, where we have an expectation that we can convert that WIP into cash. To the extent there's ever any doubt over recoverability, we've got a robust monthly provisioning process where we would write down that work in progress. In terms of liabilities, the key things out there are partners' profit. So partners get several forms of profit share. There's an element that's paid monthly, and there's an element that's paid subsequent to the year end, which is shown as a liability here. In summary, it's a strong balance sheet. In terms of the cash flow, you can see here from profit before tax to net cash from operating activities, we've got a really strong conversion of profits into cash. I will say that in terms of our work in progress, we do have slightly stronger cash collections in the second half as opposed to the first half. So I do anticipate as we go into FY25, our WIP will build slightly for the first half. Also on the cash flow, the other big thing to call out is there was a slight timing difference in terms of the payment of tax, which is why there's a difference year on year in terms of the tax paid. That's pure timing. In terms of capital allocation, this is rather simple. I guess our main thing is to continue to invest in the business to drive organic growth. Supporting that, we are very selective in terms of our approach to acquisitions. We do have an active pipeline at the moment, but we are very selective, subject to the following criteria: the cultural fit of the individuals, the strategic fit, both geographically and within our service pillars, and making sure the economics are right for both sides. We also have a quarterly dividend policy, as I mentioned earlier on, 3 smaller interim dividends and a larger final dividend policy, and that has been progressive since IPO. Any other forms of distribution of capital, we would take advice at the time and we would determine what we would do. Back to Jeff for our outlook statement.
Thank you, Gavin. So to reconfirm, our strategy is built around steady and sustainable growth, both through organic initiatives and selective acquisition opportunities. Part of the organic growth strategy is to ensure that FRP's offices across its 28 locations in the UK and 2 international locations are connected and work well together. This supports our delivery of sustainable, profitable growth by drawing on specialists from our 5 service lines as necessary in order to provide each assignment with the right team to deliver the best possible service and outcome. Our M&A pipeline remains healthy, and we are in active discussions at varying stages regarding a number of opportunities that will potentially further enhance our ability to support clients through their entire corporate lifecycle. Trading in the first few months of the current financial year has been positive, with good activity levels, and is in line with the board's expectations. This includes the financial contribution of recently acquired businesses where integration is progressing as planned. We remain fully committed to retaining our healthy collegiate culture, where we promote the development, health and well-being of our colleagues. As demand for our services continues to increase, and as a people business, this approach will be critical to meeting our goals.
Fantastic. Thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Guys, I'm just going to pop your cameras up and bring your microphones on, if I may. There we go. Camera's coming up now. Microphone's coming on. As you can see, we've had a number of questions throughout today's presentation, and thanks to all the investors for submitting those. Perhaps, Gavin, if I may just hand over to you to click on that Q&A tab where appropriate to do so, read out the question and give your response, or direct it to the team, and I'll pick up from you at the end.
Thank you very much indeed. So the first question, I'll partially answer and then get Jeff's view secondly. So the question has come in. Your brokers indicate revenue growth of approximately 15% into FY25, but margins, profitability only growing by sort of 5% year on year. Surely these margins should be increasing. What percentage of revenue increase are you going to push partners towards? Now, first of all, I would say FRP's house style has always been cognizant of we don't completely control what can happen in future, and we would often invite people to judge us upon what we've been able to consistently deliver in the past. We are generally a slightly conservative management team. And Jeff, what would you add to that?
Yeah, so as you know, we target sort of high 20s margins, which we've achieved, and obviously history says that we have delivered approximately 15% CAGR, and as you see from the last set of results, that increase in profitability was matched by a greater increase in profitability. So all things being equal, one might hope that can be repeated based upon our past performance. But as Gavin says, we tend to take a conservative approach given the transactional nature of our business. In terms of the second part of the question around what percentage of the revenue increase will be going towards partner earnings, so we operate a formula which is based upon partners having what we refer to as a base profit share, so akin to a salary. That needs to be market competitive, but we've always structured ourselves on the basis that a significant element of partner earnings are linked to the performance of their office. We don't run individual partner targets. We deal with it both by office and then an element of profit being allocated on a national basis to reward the good behaviours. That is a formula, so approximately 25% of the profit that is generated in an office after base salaries is available to the partners within that office. So it's a formula position, subject to the caveat that obviously we just need to make sure that as regards base salaries, we are broadly market competitive, but we've never been an organisation that has found the need to pay, above market rate or top dollar, whatever phrase one wants to use, recognising that we want to make sure that we keep our cost base, or broadly our fixed cost base, well under control.
So the next question that's come in, I'll answer, and then I'll see if Jeremy has anything to add. With acquisitions, how do you look to shape them? And how do you ensure you get cross-selling across the group? And what metrics are really key in structuring deals? So first of all, our approach to acquisitions, as was mentioned in the deck, is making sure there's a cultural fit, a strategic fit, and making sure the economics are right. Because we're acquiring people teams and their relationships, we always structure deals which have an element of upfront cash, an element of restricted equity to tie those people to FRP for a period post-deal. Equally, we're always very cognizant on the fact that opportunities come to us normally through recommendations internally. So a case in point might be Lexington, the corporate finance business that was mentioned to us by our partners in Bristol that knew of them and knew of their reputation. So we do a lot of due diligence before we reach an agreement. In terms of the cross-selling, Jeremy, in terms of service lines and making sure that we open up the full services and a broader service offering, what would you say to that, Jeremy?
Just going back to the earlier point of the take on, obviously we are well aware that we will be amalgamating central service. There could be some reduction in headcount. There's certain areas that where we do centralise activities in certain of our functions. So we are mindful that can we repurpose people within things we acquire, and occasionally we can't, and we will slightly reduce headcount. So we just got a sensible commercial nature there, but being cognizant of we are a people business, and make sure we're positive with the feelings of the people, or the majority of them, of the people. When you're looking at cross-selling, we're bringing businesses in that we feel fit comfortably under an umbrella. The umbrella might get wider, but they are all essentially focusing and facing a very similar client base, and cross-selling or cross-introduction or working on projects together is not human nature, but the direction, the influence from the top, we make sure it becomes human nature.
And I think you'll see from the previous RNSs we've put out on acquisitions, we've paid historically between a 4 and a 4.5 times multiple of the relevant profit. So that's typically how we sort of transact. The next question is one for Jeff in terms of the balance of resources we have in each of our specialisms, percentage of revenue, etc. How do you think the shape of FRP might change, and how do we look at that, Jeff?
Yeah, so for those people who aren't holders in FRP, our history is firmly sort of rooted in the world of restructuring and insolvency. And when we came into existence back in 2010, we were basically solely, that was our service line. The evolution of the business fundamentally has been, how do we get ourselves into transactions that provide us with an opportunity to achieve remuneration at the sort of the margins we're seeking, and the evolution then has been coming into areas such as corporate finance and debt advisory as regards supporting our restructuring offering. The original position on forensics was very similar as well. What's then happened actually, which is very encouraging, is that in areas such as corporate finance, the predominant amount of work we're now doing is not related to our restructuring offering. It is lead M&A advisory. Similarly, with forensics, increasingly we are picking up projects which are not connected to the world of restructuring. And fundamentally, we don't look at the business of saying we need to get to a point of saying we've got 25% of corporate finance and 20% of forensics and 15% of financial advisory. That doesn't mean we're not aspirational to try and increase, the success of those service lines, but we're very cognizant if we set ourselves what might actually be artificial targets, we could then find ourselves either undertaking inappropriate M&A or recruiting inappropriate people that ultimately we don't succeed in that desire, and potentially worse than that, we damage, some key elements of our culture. So we can't get away from the fact that restructuring is the largest part of our business, but equally the success of restructuring is absolutely impacted by what we are achieving in our other service lines. And although not a question, we are also very open to the prospect that we expand our service lines in due course on the basis they have a relevance to what we are doing already, so that there is always an element of connectivity within our business. We don't seek to be the owner of a number of businesses that don't have a connection.
So there's the next two questions I can take. Somebody has asked, thank you very much for this open forum. Can this be repeated in future? Yes, absolutely. I will also say that we do have various resources and past presentations and our accounts all on the investor section of our website. So that is all available. We realise we're not the finished article. We're constantly learning on how things we can do differently. So this is the first time we've opened up to this sort of IMC platform like this with this Q&A, and we'll be more than happy to do it again. The next question came in, sort of notes the operational gearing, and it talks about the forecast for FY25, where we have a higher growth in sales and a more modest growth in profitability, i.e. there's a future margin out there of 27% when we're currently just delivered 29%. From our perspective, this is very similar to the first question, where we still have lots of uncertainties for the rest of the year. But overall, the biggest thing I say, our house style is always slightly on the conservative side. I wouldn't want to promise a similar margin. However, I would invite you to judge us on our past and our track record of delivery. We are much more about under promise and over deliver than the other way round. Jeff, anything else you would add on that point?
No, I just concur with what you said. So I can fully understand the question, but as I say, it's just been our approach, and as you say, hopefully what we have previously delivered gives investors confidence as to our ability as a business and as a management team to deliver on a consistent basis.
Fantastic. I think you've covered off those questions there, Gavin. Of course, any further questions that do come through from investors, the company will be able to review those and publish responses where appropriate to do so on the Investor Meet Company platform. Before redirecting investors to provide you with their feedback, which I know is particularly important to you and the team, Jeff, if I may just ask you just for a few closing comments.
Just obviously thank everyone for making the time to join us today. I very much note that comment around having similar presentations in the future, and we look forward to the ability to engage and hopefully to have ongoing discussions around the success that FRP has been able to achieve, and hopefully will continue to achieve in the future. But I hope everyone has a wonderful weekend.
Fantastic. Thank you indeed for updating investors today. Could I please ask investors not to close this session? You should be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete, and is greatly valued by the company. On behalf of the management team of FRP Advisory Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.